Okay, so welcome back. We're really happy to have you. Thank you for accommodating a Tuesday session as opposed to Wednesday. We will be back on track next Wednesday. Rita's going to pull up the slide. There are a couple of handouts that you'll need to have for your breakout session. You'll need the limited partnership agreement. We've used that several times now, so hopefully you have that at hand. And then you'll need the first year financial statements from our deal, Restoration Housing. And so those are in the link that Chelsea shared with you. Make sure you download those because you will need those later on today. So as you know, if you've been with us, we like to sort of recap so you can kind of see where we started and where we are at this point. We are in operations. Pre-construction is done, construction is done, and we are going to be thinking about operations, but we started off.
Sorry, hold on. Sorry.
No problem.
Let me just
No, it's
say it
okay.
again.
She was so excited to get to those case studies. She's just zooming right through.
Okay, can you see my screen now?
Yeah. So
okay, the materials. Okay, great.
Yep. So 15, which is the LPA, and then handout 17, which is the financial statements for Restoration Housing. And we're going to be looking at the equity page, the page that shows you what the general partner and limited partners capital accounts look like. So that's the page to focus on, but we will get there when we get there. So here's where we started. We started by identifying the deal. Some of you only figure that out when a check shows up. So we talked about that. We talked about what those early revenue sources look like and what are they? Are they a grant, a contribution, or exchange transaction? And we explained the accounting, the differences in the accounting that you would do for that. And we talked about pre-development best practices. Very important to start off on the right foot, awfully hard to catch up if you haven't. And so I would encourage you to go back if you're doing a new deal and review that section. In module 2, we talked about the type of entities that you'd find in an affordable housing deal that's using low-income housing tax credits and what that structure looks like. In module 3, we talked a little bit more about that structure, and we talked a lot about the different participants in your deal. I think we had a list of 15 to 20 key players in a deal, so you'll have plenty of company as you go down this path. We talked about qualified allocation plans or QAPs. Every state has a qualified allocation plan, and that's what tells you what the state would like to see from a project standpoint. It might be looking for housing for folks who have been formerly homeless. It might be family housing. You really have to pay attention to the state qualified allocation plan to know whether your project will be received favorably. And then we started looking at how to calculate the low-income housing tax credit and what the state letter, the letter you get back from the state awarding you the credits, what that looks like. That's called the determination letter. So in module 4, we took you through financial projections. Those are the projections that go to everybody. They go to the state, they go to the investors, they go to any lenders. And that really has the projections for not only the construction budget, but also at least 15 to 20 years of operation. So it is your go-to document. For the next 20 years, you really want to have those projections in hand because folks are going to be comparing the actuals to that. And then we looked at investors' letter of intent. And the most important thing I can say about that is that it used to be that key terms and conditions were discussed. And when we were drafting a partnership agreement or an operating agreement, that is no longer the case. Key terms are found right up front when you're actually negotiating with your potential investors. So it's really important to be involved at that stage of the game. In module 5, we talked about new construction. We talked about the or versus rehab. And, you know, in a rehab situation, you might be facing a pretty large line item for relocation fees. New construction, obviously, you're going to have a land purchase and maybe a building purchase and maybe not, right? So that there's a big difference. And then we talked about this fancy word, funders requisition, which is really honestly just a fancy word for monthly invoice. So this is where we invoice the lender and show them all the costs we'd like to receive a loan for so that we can make sure we pay our vendors on a timely basis. In module 6, we talked about cost certifications. That is a specialized audit conducted to audit the costs of your project to make sure that we've incurred, so to make sure that we have valid costs against which the credits are issued. And then Form 8609, that's just the IRS's number. They like to number all those forms, their forms. So that's the IRS's number for the form that we submit with the very first year tax return to tell the IRS who the credit allocations were awarded to so that they can then be used on the limited partners tax return. And then scan up a little, Rita, for module 7. I can't quite see the bottom.
Oh, sorry.
That's okay. If you can see it, I know we talked about other operating issues, best practices last period. We talked about the different types of asset managers that you're going to need to interface with, right? The lender's asset manager, the investor's asset manager, your own internal asset manager, and property management. All of those players now are involved once operations commence. And so in module 7, we talked about who some of those new players are, the operating players, and we talked about some of the key documents, right? The partnership agreement, regulatory agreements, and your loan agreements. Those are all really important for you to get a handle on. So here we are on module 8, and we're going to talk about some other operating issues as we're now in full swing, some accounting issues that we might uncover, and some of the best practices that we have to offer you. I'm sure you'll have some additional best practices, so we'd love to hear from you, but just a few best practices we'd love to offer you in terms of operating your property. So here's our poll. And when do you typically receive the deal's operating or partnership agreement? So is it before construction starts, during construction, or once operations begin? And I guess the question would be when do you typically receive it? That might be different from when you ideally should be receiving it. And Chelsea's going to share those results with us as soon as she gets them. Remember, if you need CPE, you have to answer the polls. Okay, that's great. 65% of you actually see the agreements before construction begins. That's the goal, which is awesome. And for some of you who are only seeing them after operations begins, it could be that your role, it's okay that you're seeing them after. So it could be that you're in a role, maybe a tax preparer, for example, that would only see it after operations begins. And that's okay because they wouldn't necessarily be in a position to change those documents. They're just abiding by the documents. So depending upon your role, actually all 3 of these answers could be correct. So thank you, Chelsea. And I'll turn it over to Rita. Oh, is this mine? This is still mine. You know, Rita, I can't see the page numbers on the bottom. So if I'm missing something, just let me know.
Okay, we're on page 10.
Okay, so construction payables. So a couple of accounting issues. This is based upon some of the things that I've seen go wrong when people try to review our financial statements. So almost always you will have construction continue into some part of your operations, right? Never will you have this perfect cutoff where construction finished on Friday and operations begins Monday. There's always stuff that kind of finishes up, and landscaping is a good example of that. It's really important to separate your construction payables from your trade payables because construction payables are going to be paid from additional loans, whereas trade payables are going to be paid from receivables and cash on your balance sheet. And if you commingle the two, you're going to make your balance sheet look in a much weaker position than if you were to separate them because they have different funding sources. So if you can set that up in your AP module, usually in most AP modules, you can code where the payables are going to. When you put an invoice into the system, you can code it to actually post to construction payables. Please do that. I will also tell you that there is some thought out there, and I happen to be in this camp, that construction payables ought to be long-term liabilities, not current, because they're being paid by a long-term source, right?
Right.
So really, if you're thinking about your financials, construction payables ought to be down in non-current liabilities because they're not going to be paid by current assets. So if you keep them up in the current liabilities section, I can guarantee you there are lots of folks not as sophisticated as you all in reviewing financials who will assume that working capital, right, your current assets, all of your current assets, cash, receivables, are needed to pay those construction payables, which is not the case. Okay, so think about that at year end. Think about how often you report, when do you care about moving that? Maybe you only report quarterly, so do it quarterly. It just depends on who's getting your financial statements. And so I would incorporate that into whatever frequency it is you're issuing your financial statements and to whom. But for sure, your audited financial statements should present the liabilities this way, because that is the document that is usually viewed by most external folks, right?
Yeah.
So really important point. Related party transactions, Rita's going to spend some time to talk about this with you. And so there are a lot of related party transactions, and you're going to see that in your agreements, that there are several fees that are payable depending upon whether there's surplus cash. So, and I think it's on a subsequent slide, but one of the things to think about, if you happen to have a seat at the table when all of these documents are being produced, I really like the idea of having fees that look sustainable coming out of the surplus cash model, as opposed to a distribution. So if you think about partnership distributions, what if you budget for them? Some people budget for them, some people don't. If you budget for them, that is really just a function of what our cash is thrown off at the end of the year. Whereas if you have a standard fee of 10,000, 15,000, and we're going to see some of those, I personally think it looks more sustainable in terms of how your operations are perceived. So if you happen to have a voice at the table as these agreements are being drafted, I always ask, how much of this can we actually convert into fees that are payable, as opposed to having it drop to the bottom line and having it be just a distribution. So I think Rita's going to talk with you a little bit about, I guess is this a second poll?
You went back, sorry.
You went back, okay. It was a trick question. I thought you were going to.
I know it is. Making sure everyone's awake.
Yeah.
Okay, so I'm going to talk about the fees. You can see from this slide that there's many fees that you would typically see on an affordable housing deal. But before I do that, I want to jump into the next slide first. So these are the attributes of the fees that you may see. And I think I'd like to go over this first before we go through all of the different kinds of fees. So what are the different attributes that these fees may have? On the slide, you'd see it says cumulative or non-cumulative. What this means is if the fee is accruable, whether or not there's excess cash, then it's called cumulative. The opposite is you only accrue it when there's surplus cash, then that's non-cumulative. So you would have to make sure that you know whether your fee is a cumulative fee, meaning you should accrue it. You don't even have to worry about excess cash at all or surplus cash at all. Or you wait until it's calculated before you could accrue it. Some fees are fixed amount, 5,000 per year, for example, but some fees can escalate. It might, the ones that I see would be some fees that escalate maybe 3% per year. You also have to know whether the fee is interest bearing or not. Most fees are not, but that's not always the case. So you actually have to look at your agreements and make sure that it does not say that it's interest bearing. I've seen some, very seldom, some deferred developer fee that would have an interest on it. And so if that's your case, you have to make sure that you know that. Some fees are payable from surplus cash, but some are payable from operations. So fees that are payable from surplus cash, obviously you don't pay that until you know that there's a surplus cash for that. The first item I said cumulative or non-cumulative, right? So the first item says you would accrue it, whether or not there's surplus cash. The last item I just mentioned is payable from surplus cash. So the ones that you accrued, you can either pay that from surplus cash or from operations. It depends on what your agreement says. So are the fees, oh my God, I'm so sorry. I wonder what's going on today. I keep jumping from one slide to another. I'm sorry about that. You have to
go
know,
back one, right? Just
right. I'm in the last one. Fees paid to arrive at net operating income. It's actually called above the line fees.
yeah.
So these are fees that you would record in order to get to the net operating income. And the line that we're referring to here is the net operating income. If it's a fee that it's recorded above the line to get to the net operating income, it's what you call above the line fees. Or it's a fee that is below the line to arrive at the net income. Usually the below the line fees are payable from surplus cash, and we'll talk about that when we get to the next slide. The other thing that is not here that I wanted to add is there a cap on these fees? You have to know if there's a certain cap that you could accrue or pay. I've seen fees where it would say the total of the property management fee, assuming the property management fee is a related party, the management agent is a related party, the total of the property management fee, partnership management fee, or any other fees payable to general partner should not exceed, say, 10% of your total cash receipts for the year. So you have to know that, because you can't just keep accruing fees not knowing that there's a certain cap on these fees. Okay, so having known these attributes that we need to make sure we know, let's go through the list of fees that you might see on your deal. The first one is a property management fee. It's always there. You have to pay a management agent to run your project. And this is the fee that's paid to sometimes a related party, but not all the time. It's sometimes paid to a third-party property manager. In our example deal, Restoration Housing LP, when you look at the financial statements, it says that the property management fee is payable to a third party. It's not a related party. So it's not always a related party fee. This is accruable. You have to record this. You have to pay this. This is above the line. And depending on your agreement, it can be a fixed fee or a fee that can escalate. But it's always payable from project's operations. It's never payable from excess cash. Partnership management fee is usually payable to your general partner. It's usually an administrative fee. It's a very nominal amount. And it's usually below the line. And it's usually payable only when there's surplus cash. So when there's none, then you don't have to pay this. I've seen some partnership management fee that is payable only when there's excess surplus cash. I don't see that often, but sometimes there's an agreement that says that you would only pay partnership management fee when there's excess cash. So investor wants all these fees, wants all these deductions because it has a benefit to them. But then they also want to make sure that they only want these deductions if they're really entitled to it. And they're entitled to it when they know that it's going to be paid before they make their exit. So at the beginning of the deal, when they look at the projection and they see that it's not realistic that the partnership management fee can be paid every year, then they may request that the limited partnership agreement is crafted so that the partnership management fee is only paid when there's surplus cash. Asset management fee is usually paid to your investor limited partner. Again, it's also a nominal fee, but it's cumulative. For sure, your limited partner wants to get the asset management fee. And if you look at the waterfall distribution, and we'll talk about the distribution in all of the line items that we call waterfall, usually asset management fee is up there. They want to be paid first, usually after developer fee. So you pay developer fee, the deferred developer fee, the portion that's deferred, and then they want to get paid next. Again, it's accruable, it's cumulative, payable from excess cash, but they want to make sure they get paid. This is also one of those that I've seen in some deals where at the point of development, they would actually set up an asset management fee reserve. I've seen that in some of the deals where the reserve is funded by development sources. And again, it goes back to the limited partner wants to make sure that they get paid, and they only want the deduction if they know that before they exit, all of these fees are paid. Incentive management fee is payable to the general partner. This is to incentivize the GP in case the project produces surplus cash. So this is one of those fees that only get recorded when there is surplus cash. And it's a variable amount. You don't know what that is. Usually it comes at the bottom of the waterfall. Whichever gets paid first, you pay everything else. And then towards the end almost, it says if there's any remaining surplus cash, then 90% paid to the GP for incentive management fee. It seems like a huge percentage, 90%. But at that point, there's probably nothing left already. Or if there is, it's probably a minimal amount, depending on your deal. I've also seen some projects where it surprises them that their surplus cash is huge compared to forecasts. And what that means is they would get a big incentive management fee. Incentive management fee, because it's payable from surplus cash and accruable only from surplus cash, then it's non-cumulative. Accounting bookkeeper fee, usually whoever's your property manager, you also pay the accounting bookkeeper fee to that entity. So it can be a related party. It may not necessarily be a related party all the time. We've seen compliance fees payable to the investor. Usually it's a one-time fee, especially at the first year. I've never seen compliance fee being paid annually, but you could see it may be possible. Again, it depends on your agreement. Other fees, there could be other fees that you'd see on the deal. Other fees may include perhaps a supervisory management fee, which is a fee that you'll see in our sample deal, restoration housing. There's supervisory management fee there. Developer fee is another fee as well, although it's not an operations fee. It has been accrued at the point where construction is happening already at that point, but it's another fee and it's usually related party. Any portion that's deferred from developer fee gets paid from surplus cash. And again, as I mentioned earlier, usually developer fee gets paid first whenever there's an excess cash. And the idea is because since this is part of basis, you wanted to make sure that this gets paid. So the moral of the story, you see all of these fees and all of these attributes, there's a lot. And can you imagine if you have 10 projects that you're looking at and taking care of, 10 projects, 20, 30, 40, 50. What this means is you really have to read the agreement and you actually have to summarize them. Last module or the previous module, we were talking about the deal book or however you want to call it. Make sure that you're able to summarize all of these fees, from which agreement you're getting all these fees from. If you can get a snippet, make sure that you know which agreement, especially if the agreement gets updated, you want to make sure that you're looking at the most recent version of the agreement. And it's better to do that at the beginning instead of catching up. Let's do it right the first time. So again, the moral of the story, read the agreement, make sure you summarize, make sure you know what fees you need to accrue, which fees you need to pay from operations versus surplus cash. We went through this already. So now we're ready for our second poll. Which of the fees discussed will most likely be accrued only when there is sufficient surplus cash? Is it property management fee, accounting bookkeeper fee, developer fee, incentive management fee, or C and D above, meaning developer fee and incentive management fee?
Just focus on the word accrued.
Yes.
I've got one person who hasn't voted yet. Going once, twice. We will call that a poll.
Yeah, that's okay. Some folks, Chelsea, are not needing the CPE credit, so
Okay, most of you answered C and D above, which is both developer fee and incentive management fee. I think the word that's important in this question is likely to be accrued only when there's sufficient surplus cash. So developer fee is going to be paid only when there's sufficient surplus cash. However, it has already been accrued during development. That was already established when you're doing the construction. Property management fee is always going to be an expense of the project, and so is the accounting and bookkeeper fee. So now it brings us to the only other item is the incentive management fee. So incentive management fee is likely only to be accrued when there's sufficient surplus cash. Thanks everyone for answering that, Paul. Brings us to, is it too early to have a break, Gail?
just flip to the next slide. We're only a half an hour in.
Okay. All right, so Paul number 3.
Well, so that's our coming back poll. So why don't we let people take a break, because otherwise we're going to be off. But,
Okay.
you know, if you want to just break for 5 minutes or so,
Okay,
and we'll see you back. So it's 1/2 the hour. So I guess 20 minutes before the hour, we give you 10 minutes.
okay.
All right. Thanks, Chelsea. Have you learned anything today that might help you? And it's okay if you say no. It just depends on what you do for a living, right? This is more to make sure you came back from break, from lunch, like I was trying to sneak a couple bites in there on break. For those of you on the West Coast, maybe you're trying to sneak in some breakfast.
All right. We will call this a poll.
Okay, I love that.
That's
At
good.
least some of you are thinking about it. Maybe. Okay, I'll take a maybe any day, my friends, any day. So, so thank you so much. We really appreciate that. We work really hard to produce something that's of value to you. So good to hear.
Okay, we're gonna have a class exercise. We're gonna go to the breakout room for this exercise. And so you will try to identify the fees that you can find in our sample deal, restoration housing. And please have the partnership agreement ready, especially the definition section and or section 10, which is the distribution. So please have that ready so that you can refer to it. You may also, because you have handout 17, if that's also available to you right now, then you can also look at the financial statements, because that also has a certain note that talks about the fees for this project. Okay, Chelsea?
Sorry, the agreement is what attachment again? Sorry, our
It's
handout number.
15.
15, thank you.
Yeah, it's 15.
Yep.
So we need 15 and 17.
And 17 is Restoration Housing LP audit.
Yeah, it's the first year audit. So you should see the, we're going to be
Finance.
looking at the page that shows the partnership agreement, you know, the partnership split. So somebody was looking at poll 3. Chelsea, can you just look in the chat? Somebody was asking about,
I
and
got it.
what's on page 15? No, so it's not page 15, it's handout number 15,
Yes, handout number 15.
which is the
that's
limited
the-
partnership agreement, and then
Correct.
handout number 17, which is the first year audit.
All right.
Okay,
And
Chelsea?
how long will people have in their breakout rooms?
10 minutes or 5 minutes? Gail, what do you think?
Yeah, 10 minutes is fine.
10 minutes. Okay.
All right, and handout 15, that is the limited partnership agreement, and you need to, so if you just look right here on the slide that Rita's showing, you're going to use the definition section or section 10. So you're going to be in the partnership agreement, in section 10, that's going to describe the waterfall, what comes. So when we say waterfall, it just means how is the cash distributed? Who gets the first amount of cash out of whatever surplus there is? Who gets second, third, fourth? It's a priority schedule. And somebody cleverly came up with this word waterfall that we now have to explain every time we teach a class. So whether you like it or not, there we are. So in section 10 is the waterfall section that will tell you who gets cash and in what order surplus cash is distributed. And remember, I told you last class, I guarantee you, you're going to go to section 10 and it's going to say incentive management fee, and that term is going to be capitalized, and you're going to have to go back to the definition section to understand what that is. And or you might end up back in the addendums. So just do the best you can. We're going to go over the answers with you. So if you don't quite get there, that's okay. What we're trying to get you to do is get used to working through a partnership agreement or an operating agreement. Remember, partnership agreements for partnerships, LLCs use operating agreement. They're the same document, just different names. We're just trying to get you used to actually walking through those so that you're comfortable with that. So I think we're ready, Chelsea, to send folks off.
Go. Be asked to go to your room.
I was muted. Okay, we have the answer key. Gail, would you like to go over this with everyone?
There's nothing I would rather do more. I know you all got it right. I know you all did. So we kind of gave you a little hint. Identify the fees that you find in Restoration Housing's partnership agreement. And in section 10.1, you should have seen these fees. Did everybody see? Asset management fee isn't very up high in the waterfall.
Yeah,
Well,
step
yeah.
one, they want to make
Step
sure that
one.
they're paid. Yeah.
Step 3 is your development fee. And as Rita explained, that's always very high on the list because we want to make sure that it qualifies. It has to be paid in order to be qualified basis. There are some things that happen if it's not paid by the end of the 10-year period, but that's the advanced class. And hopefully none of you will have that happen to you. So in any event, development fees are very high up on the waterfall. Partnership management fees, step 5. In our case, we have a supervisory management fee that's paid to the general partner, and that's in step 11. There is a management fee also that's found in the LPA, but you'd actually have to go to the partnership management agreement. So if you have third-party property management, for sure you would have a management agreement that would specify how much the fee is. The fee is based upon collected revenues. So that would be revenues less any bad debt expense write-offs. It can be anywhere. I've seen it from 5 to 12%, depending upon the property. So you'd want to look at your property management agreement. I would suggest that if you have internal property management, there probably is some internal documentation also that would govern that fee, so that your property management company probably has its own revenue line that they're billing to the folks who are running this. So deferred development fee, that's a great question, Patricia. No, so deferred development fee is just the development fee that had to be deferred from payment because there were not enough construction sources to make the payment. So we deferred the payment of the fee to operations, and now that fee is payable from surplus cash out of operations. So sometimes that's planned, and we plan on having to leave so much development fee in the deal. And sometimes, unfortunately, it's not planned and it ends up being deferred because we need the construction sources to cover other construction costs. So really important for you to know that, because if you're counting on that development fee to be paid, at any particular time, you need to understand how much of it is really coming out of construction sources and how much is expected now to come out of operations. And if your property is not really cash flowing, so in the middle part of the country, there could be very slim margins. Even the western part of Massachusetts, we can have deals with very slim margins. And so it's possible that we won't actually see the payment of that fee, or it'll be a slow process over some period of time. So if you see the word deferred, it means that it did not get paid out of construction sources. So did everybody see those fees? And did you have to go to the definition section to sort of see what they were? Maybe you didn't take the time to do that because we didn't ask you to. We asked you to just identify the fees.
Yes, some of us actually also went to the definition section.
Nice.
Yeah.
Nice. So like I said, you can find how the fee is calculated in the definition section. Oftentimes, though, I typically see them in addendums. There'll be an asset management fee agreement, a development fee agreement, a partnership management fee agreement, and they're addendums to the partnership agreement. They're like addendum L, JKL way in the back. And those are the agreements that you're going to look to tell you whether there's an incremental increase, whether it's 3%, 5%. You're going to want to see those fees so that you're calculating that. And then I keep a surplus cash workbook, and I have those calculations in that workbook.
It's also here, Gail, would you like to? I think I mentioned earlier that on your handout number 17, there's a note 6 for related party transactions, if you want to see more details. And quite honestly, when a draft of the financial statement is sent to you, you want to make sure that every detail in this footnote is correct, and you will compare that to your deal book or your summary. So that also has all of the fees that we talked about.
Yep. And I'm sorry to say to you, I can't tell you how many times I've come to a new company and found out that these were wrong, that the disclosure's wrong.
Right.
And somewhere along the way, I don't know, I'm not pointing fingers who, where, why, what, when or how, but either the auditors are new and they just take the prior year audit, they're just rolling forward the prior auditor's work, or, your finance people are new and you're rolling forward stuff you had. It's really important, if you're going to take responsibility for this, that you go back to the inception of the deal, because you might find money, which is what I did when I was with a couple companies ago. I found money that was due to the parent, the nonprofit. So don't assume that these are correct. Be a stickler about them. It's really important that this be treated properly. If a fee's not, I've had a deal where we had a fee that was classified. The actually audit firm classified it as one fee, and it should have been another fee. We ended up correcting that over the next year or two in the financial statements. So it's just really important, because if you don't get this right, you could be skipping over fees that are due to you. And as they say, right, cash is king. So you don't want to skip over these. Just go back to the original source documents. Make sure you look at the original source documents. Make sure you are calculating from inception. Hopefully you can see what fees have actually been paid. That's another challenge sometimes, actually understanding what's been paid. And sometimes your third-party sources don't necessarily know. So we had a couple city lender, a couple of loans with the city of Boston. And they, a couple of years ago, bought new amortization software, and they hired a third party to transfer all the loans that they had to this new software. And guess what? It did not go well. And so they were sending confirmations out to our auditors saying that we owed them all kinds of money that we did not owe them. And so it was quite a challenge trying to work with them and say to the auditor, I know the confirmation says this, but I'm telling you, this is what it should be. So it's just so important for you to keep your own books and not rely on third parties to maintain them for you.
Yeah. The other thing too is every time there is an amendment or amended and restated version of the partnership agreement, or any updates to the agreements where these fees are based off of, you need to make sure that you summarize, you update your summary, and you also need to make sure that you give a copy to your auditors. It's
Mhm.
amazing how sometimes you would find later on after so many years that, like you said, Gail, whatever you're disclosing is not anymore updated because there's apparently an update to that and no one knew. And I guess it went to someone's drawer and no one knows about that. So
Right.
it's important that you always summarize, and it's important that you always update your summary based on whatever new version of the agreement.
Right.
Okay. So some more fun things that you might encounter. So when a sponsor sells a project to its affiliated organization that it controls, so the sponsor selling the project to another partnership agreement that it controls because the GP is affiliated to that sponsor or the GP is the sponsor, then GAAP requires that the acquisition is recorded at the carrying value, not the fair value of the project. So say that the carrying value of the project is 2 million. This is after all of the depreciation adjustments. And so at the point of sale, it's 2 million. Chances are the related liabilities, the loans associated to that project would be a bigger amount because usually these loans are deferred or it's payable from surplus cash and there's not enough surplus cash every year to pay, to make a substantial difference. So say your notes payable in total has a value of 5 million and then your project is, the property and equipment is at 2 million. So what do you do with this 3 million of a difference that you need to debit? Where do you debit this 3 million amount? So this 3 million is recorded in the equity section of the partnership financial statements. And it's usually called something like excessive liabilities assumed over assets acquired. And this is allocated to the general partner. And this is one of the reasons why you wanted the investor to come in after the sale of the project, because you don't want the limited partner to get allocated this huge, significant debit balance. So you would allocate this in its entirety. So the 3 million gets allocated to the general partner. This will also create a permanent gap to tax difference. In a similar situation, there might be a sponsor loan that's given by the sponsor to the partnership. There are two ways to record that. One, you could record that as an equity contribution, or you can record that as a loan payable to the sponsor. In the audits I've seen this as being recorded as a loan payable to the sponsor, but that's not necessarily the only way to do it. You can also record that as an equity contribution. Now, if it's an equity contribution, it's important to know that your tax return will have a different recording for it. So tax allows the step up in value to be counted in fixed assets. So for your tax return, it's going to be 5 million. But for GAAP financial statements, it's 2 million. So there is that difference between tax and GAAP. And it also, for tax purposes, it allows for the recognition of the sponsor loan. So for your tax return, the sponsor loan is recorded as notes payable, which means in your tax return, they would record interest expense. So it can be a little complex when you record that as an equity contribution. Know that there will be these differences between your return and your GAAP financial statements.
Yeah,
I just go ahead.
So
Yeah.
I just want to point out, Rita's being kind when she says, you might have a difference of 2 million, the GAAP financials show the fixed assets at 2 million net of accumulated depreciation and the tax shows 5 million. So I will tell you, one of the deals that I did had originally syndicated in 1970, and it was re-syndicated in 2012. And the difference between GAAP and tax was more like 30 million. So the building appraised out for tax purposes at $30 million. From a GAAP standpoint, the original building had almost been fully depreciated and was worth less than $2 million. So your financial statements look quite odd because you have $2 million worth of basis, but we just said that the appraised value is what dictates the construction loans coming in and the equity coming in. So you can have market-based construction loans and market-based equity coming in on a GAAP balance sheet that has carryover cost of the building. So I explored this at one point because I think it's sort of ridiculous. And so where I got to on this is that unfortunately HUD requires GAAP financials, because I was inclined to say, well, let's just issue tax basis financials that shows market rate building, market rate debt, market rate equity. And where I got to with that is that HUD really requires GAAP basis financials. They seldom look at the balance sheet. And so we do still have to issue GAAP basis financial statements. But understand, if you really want to understand the economics of your transaction, do not look at the GAAP financial statements, do look at the tax returns.
Right. There may also be other lenders who would require a GAAP financial statement. So you also need to make sure that you know that. One of the things I usually do when we audit a project that has a similar kind of issue where the equity is so negative for the general partner, on the first year, you would have a disclosure for this, but then sometimes the disclosure drops on the second, third, fourth year. And now you're looking at the financial statements and you're seeing, why is the general partner equity such a huge, say it's 30 million when it started, such a huge debit balance? So what I'd like to recommend to clients is to add that footnote that will always be there so that it explains what happened at the beginning. And then no one's wondering why is there a huge debit balance on the general partner equity. Allowance for uncollectible accounts receivable, and it pertains to the intercompany receivables between the sponsor and the affiliated organization. And I'm talking about this from the perspective of the sponsor. So the sponsor would have receivables, and this will be the fees that's owing to the sponsor, and can also be some advances. So the question is, are you going to put an allowance for uncollectible accounts receivable? Most of these fees are payable from excess cash, and depending on the situation for your deal, you don't know whether you would get paid. So the question would be, what am I going to do with this receivable? Should I provide an allowance for this? And it largely depends on your policy in your organization. If it's a policy to provide for allowance for all receivables, including intercompany receivables, then obviously you would do that. From the consolidated standpoint, when you consolidate all of this financial information, that gets eliminated. One thing that you may want to consider too, though, is when IRS looks at these receivables and they see, when they look at the column for the sponsor, that an allowance has been provided, then they might question and say, oh, you've used these fees as a deduction on the partnership at the partnership level. And they might deduce that the fees were not valid deduction in the first place. So just something to think about when you're looking at maybe adding a policy on your organization. Okay, we're ready for our poll number 4. When would GAAP allow you to record fixed assets at market rate upon purchase? Which what Gail has been trying to do. So when would GAAP allow you to do that? Okay. We have the results. 71% of you think that it's when it is purchased from an unrelated party, and that's the official answer. When it's from an unrelated party, then you could record it at
At
fair
fair
value.
value. Yeah.
fair value. Yeah.
So why is that? So basically, the accounting rules want to prohibit companies from selling stuff to themselves, right?
And then record income.
And then
and
recording
claiming that.
gains on stuff they're just selling to themselves. So you can imagine like the Enron of it all. You could completely inflate your balance sheet if you sell your buildings to your wholly owned subsidiaries that then, mark them up to market. So that's the logic behind that. And so you're not allowed to write up the value of the assets when you sell it to a related party. My objection to all of this is that almost every other aspect of our LIHTC transactions are guided by market rate third parties, lenders and investors who are market rate third parties. And so I don't have the ability simply to decide what the price will be all by myself. It is really determined by third parties, but apparently nobody at the FASB is listening to me yet. So I'll let you know if I'm successful. But there we are.
Okay.
All righty. So some of these things, we're kind of getting to a point where we've talked about these a little bit as we've gone through the seminar. So what types of things do we need to be thinking about during operations, right? So reserve funding and withdrawal issues and surplus cash distribution. So I will tell you, I'm at a new place, 6 months now, and one of the deals that I have, it's not a LIHTC deal, but it was a rehab of an existing building, and the lender never required any reserves. And in talking with the other players, I've learned that the lender is very new to this industry and didn't think about that. And I thought, okay, that's great, but now I don't have any reserves. So you can really see the gamut here, right? Like you can walk into a situation where there was no reserve requirement and now I'm trying to create that. Or you can walk in and find that you've got very large reserve requirements and maybe those are hindering operations, and you might have to have some discussion with some of the parties involved to get the reserves to where you want them to be. And certainly withdrawal issues, you need to know who you need to ask for approval to withdraw from reserves, particularly replacement reserves. It's really important to know that because you are going to be out some cash flow if you can't get your whatever fixes you're doing, whatever your construction is. If you are paying out of operations and you can't get the funds out of replacement reserve quickly, you could really have a problem with your operating cash. So, and then we just went through some of the surplus cash distribution issues. You can see that's really important for you to know that those fees, some of those are required, and they too are going to affect your cash balance. So really important to know. So sometimes, almost always actually, there are contradictions, and for reserves, surplus cash amongst our different lenders or in our regulatory agreements, almost always there are contradictions. So the state wants you to calculate it one way, the city a different way, and then your partnership agreement a third way. So how do you handle that? So typically what we try to do is look at the lien position. So generally we look to the lender that has the highest priority, and we tend to use their calculation if we can. You might have, like in the city of Boston, they won't have anything to do with that. And then actually their calculation sometimes yields a lower payment to them than they might have had otherwise, and sometimes a higher payment. So you have to sort of figure out what are you going to do with all that and understand if the city of Boston, for example, demands a higher payment, are you in violation with your first mortgage lender or some other lender because you're now required to pay them at a higher level? So all that to say that you have to understand all of your agreements and to see where discrepancies are and try to work through those as best you can. Ideally, when the documents are being written, we would have considered all of that, but that is unfortunately not the reality. Most of us don't get to make those changes. And so you're just left to deal with them, which is the moral to this entire 11 course series. What happens when you're left to deal with all this in the operations fees? So what you need to do first is understand what you're left with, and then secondly, understand who the players are. And you might have to go and say, here's the issue I'm having. I'd like to abide by your agreement, but I have this conflict. How can we work this through? And generally speaking, if you're being upfront about it, most folks will try to, in fact, work with you.
Hmm.
So really important to understand, reading through your agreements, if there's contradictions between the agreements. So best practices, everything you do for the auditors should be done monthly. I might also say quarterly, depends on what it is, but routinely, I guess is the word that we should use here, routinely, because you don't want to find a surprise when you're going to do the audit prep at the end of the year, right? Because if you're finding a surprise, it means that you've not been reporting consistently throughout the year, which can be problematic, right? If you have large entries at the end of the year, it really speaks to the accuracy of the interim financials that were issued. Your balance sheet accounts should be reconciled routinely, monthly. I would say to you, please reconcile your intercompany accounts monthly. You might think that's overkill, but I can assure you that I have not walked into a company yet where the intercompany accounts were a mess, because people were not reconciling monthly. So it seems like a slam dunk, but it's just someplace where, especially if you have a property management company maintaining the properties books and you're maintaining the parents' books, it's so easy for those things to get out of whack. We've talked about the investor. They have very specific financial reporting requirements. It's normally in section 5 of the partnership agreement. You can see those requirements, and it'll be first off, they want a copy of your budget before it's approved. Then they want copies of the audits to review them before they approve them. They want copies of the tax returns to review before they approve them. So there are there's a series of deadlines that you need to meet. If you're going to be in jeopardy of not meeting those, do email your investor and let them know that you are late, why you're late, and when you expect to deliver. And I've not had an investor be angry yet. They're usually very patient with us when we explain where we are. It's when they don't hear from you that they don't particularly care for that. So I have surplus cash workbooks that track surplus cash year after year. So I don't do one for each year. I have one master workbook that I keep so I can track, okay, this particular line item. So as Rita was saying, there might be a cap. So I have a deal now where there's a cap. There was a particular fee that was going to the general partner and it was capped at $400,000. And it's been getting there. And finally this year we're at the $400,000 mark. So only because I can see the cumulative build do I know where I am in terms of that distribution. If I was only looking at a single year, I might see what I think I should distribute this year, but do I really know if I don't know what we distributed against that line item in prior years? So keep a workbook. That's kind of a best practice. I think it's a healthy exercise for you, kind of keeps you organized.
Right. I do also want to mention when we were talking about everything, the first line there, where everything you do for the auditor should be done monthly. I hope, and I'm sure that's the case for all of you, that you're doing it not for the auditors. You wanted to do it because you want to make sure that your books are correct, that you're doing the right thing the first time instead of later on having to fix items. So hopefully you're not doing it just because the auditors are coming, although that would be good that you're doing it for the auditors, but hopefully that's not your main reason. Insofar as surplus cash workbook, we have a client, I just want to share, we have a client here in San Francisco. And if you're an affordable housing project in San Francisco, the city and county of San Francisco has their own guide, audit guide. So you would have to submit a workbook to them that includes your surplus cash calculation. And they don't want you to pay them until they invoice you. So there's review going on, and sometimes it goes back and forth. And knowing that there's a lot of projects and there's probably not a lot of people doing all this review, sometimes the invoice comes 1-2 years later. And so it's important that these projects have a workbook that tracks surplus cash year by year and whether or not it's already been paid because it's already been invoiced. So having a workbook would really, really help. If it was a surplus cash from 2 years ago, you want to make sure that that liability is in your current portion of your liability because you're supposed to already be paying that. You're just waiting for the invoice. And so knowing your project, knowing your lenders, knowing what works for them is very important, and talking to them, just like what Gail said, it's really important. So we're ready for our last call for the day. Operational issues should best be considered during the pre-development, during the construction period, or when operations commence.
All right. We will close the poll.
And we'll have the results. That's great. 74% of you thinks that this issue should be considered during pre-development. That's really great. That's the ideal answer that we were hoping you guys would click. But then some of you, 6%, said that when operations commence. Hopefully, whatever you hear from us during the boot camp next time, you would say it should be considered during pre-development.
Right, the sooner the better. So remember that all of your documents are being executed during the pre-development stage. There's not a document that gets signed, maybe one or two, but most of the documents get signed before a shovel hits the ground. That's why it's considered to be a pretty safe investment, because everything is known before a shovel hits the ground through construction, 15 years of operations, and then with the exit strategy. So the sooner you're into the deal, the better off you are in able to influence the documentation. Okay, a couple other just tidbits we wanted to share with you. So what other final operational things to think about? I don't know how many of you are aware that there are utility monitoring systems. We have a system, I don't know if it's a national system called WegoWise, that can be installed at your building, monitored remotely, and it really does help monitor utility usage. And so that can help you track a problem that might exist. You know, if there's a broken water meter or broken something, it's a pretty great tool, and they'll compare you to other properties in your region so you can tell if you have higher than normal utility costs. So that's a great service to think about. I can tell you, working with facilities people, that they get really mad at development people, because development people buy refrigerators and stoves that look nice, but maybe on the lower end of the cost because they want as many development dollars as possible. And our facilities folks, if they were to choose, would say, hell no, you're not buying that, because that will be in repair in 3 years. That particular stove or microwave or whatever it is you purchased has a terrible operating record. And so from a facilities maintenance standpoint, we're making choices that really are not sustainable. So another good reason to have your facilities guys at the table when we're drawing up specs for furniture and equipment that's going to go in, and even HVAC systems that are going into any of these units, right? You really want to think about how durable they are, because you can buy a cheap unit at development and then have to replace that another 5 times over the 15-year compliance period, or you can spend a little extra money up front and get something that has some useful life, right?
Right.
Reserve requirements, we talked about sunsetting off if you have positive operating results. The other thing I was able to do once successfully with a nonprofit that had some investments, I was able to post a letter of credit or line of credit against a portion of the investment portfolio to serve as an operating reserve. And I was therefore allowed to take the cash that we would have had to put into a bank account, and it actually was able to pay development fee. So think about how you're collateralizing reserves. It doesn't necessarily have to be cash sitting in a bank making no money, because that's what they do these days, right? They make no money. So think creatively about how you can meet reserve requirements. it can really help. And in that case, we would have had deferred development fee, but we avoided it because we were able to use the cash to pay the fee instead. And then I talked about this earlier about can surplus cash be allocated to fees rather than distributions so they can look more sustainable on the statement of operations. You know, if you're trying to, depends on who's looking at your financials, if you're trying to sell the stability of your organization to maybe a third-party lender for organizational level capital, much nicer to show them sustainable fees that you're earning year after year than it is to say, I have these distributions when and if there's surplus cash. So I try to argue upfront about having more fees than distributions just because of the optics. So think about that if you're thinking about financial reporting. So I think that's all I have. I don't know if you have anything else, Rita, and if any of you have some other good ideas, feel free to, unmute yourselves and share with the class. That would be great. Otherwise, I think our friends at Strength Matters, if you'd like CPE, would like your answers to the evaluation poll that you see here.
And you're free to log off when you're done with this evaluation poll.
Yeah. And we will see you next Wednesday.
Right. We have an exciting topics, introduction to surplus cash and financial statement presentation.